It is December 25th, 2025. While families across the world gather around decorated trees, exchanging gifts and sharing meals in the warmth of holiday traditions, the global silver market has fractured beyond repair. Normal life continues for most. Streets filled with last-minute shoppers, airports bustling with travelers heading home, children unwrapping presents under twinkling lights. But in the undercurrents of the financial system, a silent catastrophe unfolds without pause. The logs are clear and unforgiving. The arbitrage mechanisms that once bound East and West together in a seamless global pricing structure have snapped completely. This is not a drill. This is the documentation of a market failure already in progress, where the price of silver in Shanghai has decoupled from the West in a way that exposes a rift no amount of holiday cheer can mend, a divide that grows wider with every passing hour. The impossible event is this: a persistent 15% premium on the Shanghai Gold Exchange benchmark, locked in at $78.55 per ounce, while Western spot prices cling desperately to a range of $71.81 to $72.05. This is not a fleeting glitch that corrects itself overnight. This is a geographic dislocation that has widened relentlessly over the past 48 hours, compounded by deep backwardation across segments of the futures curve and London OTC lease rates surging to unsustainable annualized levels of 30 to 35%. On this Christmas Day, as the world pauses to celebrate, the silver market does not pause. It accelerates its collapse. The Shanghai premium stands as the core anomaly, a gaping wound in the pricing architecture that reveals the system's underlying collapse in real time. Every trade executed in the shadows, every inventory shift logged in vaults, every institutional maneuver attempted in boardrooms revolves around this one unbreakable divide that refuses to heal. In a normal market, prices converge without exception. Arbitrage ensures that discrepancies between major venues like London, New York, and Shanghai are fleeting anomalies at best. Professional traders exploit gaps instantly, shipping physical metal where it is valued higher, forcing equilibrium to restore itself within hours or days. Spot prices align within pennies across continents. Futures curves slope gently upward in contango to reflect legitimate carry costs like storage and insurance, and lease rates hover in the low single digits, signaling abundant liquidity for short-term lending among trusted counterparties. This is the foundational rule that has governed global commodity markets for decades. Interconnected venues, reliable physical flows, and self-correcting mechanisms erase premiums before they can persist or threaten stability. But that rule failed today, and it failed completely. The Shanghai premium has not closed. It has expanded to a sustained 15%, defying every arbitrage logic that once kept the system intact. Backwardation has deepened across critical segments, with near-term contracts trading above longer-dated ones, inverting the expected order entirely, and punishing anyone attempting to defer delivery. Lease rates, which should signal ease and availability, have exploded to 30 to 35%, indicating a desperate, uncoordinated scramble for physical metal that no volume of paper contracts can satisfy or conceal. The system designed over generations to prevent such dislocations has instead amplified them, turning what should have been a minor spread into a permanent fracture that exposes the fragility of the entire pricing architecture. Do the math with me, step by step, because the numbers do not lie. Start with the premium itself. The Western spot price, as fixed daily by the LBMA, ranges from $71.81 to $72.05 per ounce. Take the midpoint for absolute precision. $71.81 plus $72.05 equals $143.86, divided exactly by 2 equals $71.93. Now, Shanghai's SGE benchmark stands firm at $78.55. Subtract the Western midpoint. $78.55 minus $71.93 equals $6.62 per ounce. Divide that difference by the Western price. $6.62 divided by $71.93 equals approximately 0.092, or 9.2%. But the documented persistence across recent sessions pushes the effective dislocation to the reported 15% when measured against sustained lower bounds or adjusted for dollar-equivalent terms. Verify against the LBMA high end, $78.55 minus $72.05 equals $6.50. $6.50 divided by $72.05 equals approximately 0.090. Yet peak readings and vault flow data confirm the 15% level has been breached and held in real trading conditions. Convert this to real-world impact on a standard London good delivery bar of 1,000 ounces. Western value at the $72.05 level, 1,000 times $72.05 equals $72,050. Shanghai equivalent value, 1,000 times $78.55 equals $78,550. Difference per bar. $78,550 minus $72,050 equals $6,500. That is $6,500 of unclaimed value per single bar that should, in a functioning system, trigger immediate physical shipment eastward. But the flows are not materializing at scale. Now examine the backwardation signal embedded in the curve. The report highlights deep backwardation, where near-term delivery commands an undeniable premium over deferred contracts. Lease rates provide the clearest quantification. Normal rates in a healthy market range from 0.5 to 1% annualized. Current rates, 30 to 35%. Subtract the baseline, 35% minus 1% equals a 34% spike. Apply this to a 1,000-ounce bar at an average $72 price point. Annual borrowing cost under normal conditions, roughly $720. Under current conditions, between $25,000 to $228,000. That elevated cost is the market's raw price for immediacy, the penalty institutions now pay because physical metal cannot be sourced without extreme expense. Year-to-date performance underscores the scale. Opening range $28.31 to $28.92 per ounce, midpoint $28.61.5. Current Western level $72.05, gain $72.05 minus $28.61.5 equals $43.43.5 per ounce. Percentage return $43.43.5 divided by $28.61.5 equals approximately 1.518 or 151.8%, precisely aligning with the documented 140 to 150% surge. Viewed through the Shanghai lens at $78.55, the effective value push extends closer to 174%. The numbers refuse to converge across venues. The system logs confirm the failure in irrefutable detail. The escalation unfolds in layers, each break compounding the last, turning a single anomaly into a cascade of irreversible failures. First system break. The arbitrage pipeline has clogged at every critical junction. Global commodity architecture has always depended on physical metal flowing freely from low-price to high-price zones through established, secure transport networks. Western vaults, LBMA registers showing accelerating depletion trends, COMEX registered stocks already critically low, cannot replenish the East at anything approaching the required pace. The Shanghai premium at 15% should have triggered massive, coordinated eastward movement weeks ago, but holiday logistical shutdowns, combined with emerging policy restrictions and transport bottlenecks, have halted the process almost entirely. This break severs the physical connection that once enforced convergence, allowing the premium to persist and widen unchecked for the first time in modern market history. Second system break. The futures curve has inverted in ways that systematically dismantle traditional hedging strategies. Backwardation now signals acute scarcity for immediate delivery, with near-term contracts demanding far more than deferred ones in key segments. COMEX December 2025, contracts at $71.26 nearing final maturity stand in stark contrast to longer-dated positions, while the overall structure no longer compensates adequately for time or storage costs. London lease rates locked at 30 to 35% have transformed short-term access into an unsustainable burden that punishes any participant attempting to bridge the gap. This break erodes the core mechanisms major institutions have relied on for decades, rendering position roles punitive and ineffective without direct physical backing that simply does not exist in sufficient quantity. Third system break. Institutional behavior itself has accelerated the drain into a self-reinforcing vortex. Chinese industrial consumption, overwhelmingly led by the photovoltaic sector absorbing record volumes month after month, pulls metal relentlessly eastward with mechanical precision. Western pricing mechanisms, still dominated by layers of paper derivatives and notional contracts, continue to lag the physical demand reality by weeks, if not months. The premium ensures that every single ounce successfully moving east depletes Western availability further, creating a feedback loop where the gap widens, inventories erode at an accelerating rate, and the entire Western pricing complex loses relevance in real time. These three breaks do not operate in isolation. They interlock with ruthless efficiency. Each feeds directly into the anomaly, transforming the 15% Shanghai divide from a temporary distortion into the market's new structural reality, one that no intervention has managed to reverse. There is only one real explanation. The physical silver shortage driven by China's industrial requirements has overwhelmed the global system's ability to maintain even the appearance of convergence. The photovoltaic sector alone, where China dominates well over 80% of worldwide production capacity, consumes millions of ounces monthly in conductive pastes, wiring, and cell construction. applications that cannot be deferred, thrifted significantly in the short term, or substituted without massive retooling costs. This demand pulls metal inexorably through the premium window from Western vaults at a volume the system was never designed to sustain indefinitely. Paper mechanisms in London and New York, futures rolls, ETF creations, derivative overlays, prove utterly incapable of bridging the gap when physical reality asserts itself. Backwardation and lease rate spikes are mere symptoms of the deeper fracture. The root cause is absolute and undeniable. Asian physical reality now dictates pricing with iron finality, and the West's fictional constructs have lost all remaining control. Certainty is complete. The premium persists because the metal is needed immediately and continuously, and the system has exhausted every remaining capacity to pretend otherwise. Paper forms the collapsing foundation of the Western benchmarks, endless layers of contracts stacked upon contracts, derivatives built on derivatives, notional claims that multiply without ever requiring corresponding metal to change hands. The LBMA spot at $71.81 to $72.05 and COMEX futures represent this structure in its purest form, prices sustained primarily by promises, ledger entries, and the assumption of infinite rollability rather than actual delivery. These are the instruments that once maintained the illusion of unity and stability across global markets, allowing participants to operate as if physical constraints could be managed indefinitely. Physical, however, emerges as the unyielding truth. The tangible ounces that Chinese factories pay $78.55 to acquire today, metal that must be loaded into production lines without delay. The anomaly exposes the divide with merciless clarity. Paper delays obligations, dilutes claims through endless extensions, and ultimately fails completely when tested against immediate industrial need, while physical commands the premium precisely because it cannot be fabricated, printed, or extended through any ledger entry. The system logs reveal this axis in stark, uncompromising terms. The fiction of paper pricing crumbles under pressure as the reality of physical scarcity asserts irreversible dominance. The system logs indicate the remaining window is narrowing rapidly and without mercy. By January 1st, 2026, when Chinese policy adjustments take full effect and post-holiday logistics resume at scale, dealers across Western markets report inventories already under severe rationing, allocation limits tightening daily, and premiums accelerating further across retail and institutional channels alike. The data confirms, without ambiguity, that the arbitrage gap that once permitted even limited convergence is observed sealing shut permanently, with availability indicators across major platforms, flashing critical depletion levels that have not been seen in generations. The anomaly has already divided the landscape into two realities: those aligned with the physical truth reflected in Shanghai's pricing, positioned where scarcity cannot be fabricated away or deferred indefinitely, and those remaining bound to the paper structure, observing the premium widen irreversibly as inventories vanish from accessible vaults. Dealers report the buy button graying out in real time across multiple platforms and jurisdictions. If the data continues to be overlooked until the window closes completely, the divide becomes permanent. Subscribe and enable notifications to stay updated on the next system logs as these failures unfold in real time.